The market does not usually break because investors become suddenly stupid. It breaks because an external shock hits a system that was already priced for comfort. That is what oil does. People like to talk about war as if it is a headline event, a geopolitical spectacle, a thing for television anchors and armchair historians. Markets do not experience war that way. Markets experience war through transmission, through oil, through shipping, through inflation, through interest rates, through financing costs, through margin calls, through fear, through forced selling. That is how wealth gets rearranged. So let me give you the one mother line that everything in this story serves. In a real oil shock, the first goal is not to get rich fast. The first goal is to survive phase 1 so you can own phase 3. That is the line, not bravery, not prediction, not a lucky trade. Survival first, profit later. Because if you misread the sequence, you will do what most investors always do when the market turns ugly. You will either panic because the red is louder than your plan, or you will become a hero too early and buy things simply because they fell, not because the flow is actually turned. Both are expensive. The smart money does not begin with heroism. It begins with triage. That is what I want you to understand. When oil spikes hard enough, it is not merely another input cost going up. It is the system's stress messenger. It tells you transportation is about to get more expensive, production is about to get more expensive, inflation expectations are about to get worse. Central banks are about to lose room, and every risk asset priced on easy money assumptions is about to get tested. This pattern is not new. The dates change, the mechanism does not. The market loves to believe that this time is different right before it discovers, expensively, that the system still obeys arithmetic. Oil up violently means margin pressure, inflation pressure, and policy pressure all begin crowding into the same room. That is the first mechanism. I call it oil shock transmission. Most people look at oil and think about gasoline. That is childish. Oil is not just what goes into the car. It runs through shipping, chemicals, plastics, packaging, fertilizer, aviation, manufacturing, logistics, food chains, industrial heat, military movement, and the cost structure of the entire modern world. When oil jumps hard, it is not one price moving. It is a cost signal entering everything. That signal moves outward in layers. Transport costs rise first. Producer costs rise next. Consumer prices begin to feel it. Inflation expectations harden. The central bank becomes less free. The market starts repricing every asset that depended on cheaper money, softer inflation, and policy flexibility. That is oil shock transmission. And once it begins, you do not stop it with optimism, you respect it. This is why a major oil spike has preceded so many serious market accidents. Not because oil is mystical, because oil exposes fragility. It raises the cost of motion in a system built on debt, valuation, and forward assumptions. It is the canary in the machine, except the machine is your portfolio and the canary is carrying a flamethrower. Now let us move to the second mechanism. I call it stagflation trap. A lot of investors still think central banks can always rescue the market if things get messy. That belief is one of the most dangerous remnants of the easy money era. A central bank can rescue growth if inflation is tame. A central bank can fight inflation if growth can absorb the pain. But when inflation pressure and growth weakness arrive together, the menu shrinks. That is the trap. If the oil shock drives prices higher while simultaneously slowing the economy, the central bank loses the clean option. It cannot cut aggressively without feeding inflation. It cannot hike aggressively without worsening the slowdown. It can speak, it can wait, it can try to manage expectations, but the clean act of rescue becomes much harder. That is why oil spikes are so dangerous for rich valuations. They do not merely make everything more expensive. They neuter policy confidence. Markets stop assuming the Federal Reserve or any similar authority can painlessly carry everyone through the difficulty. That is the stagflation trap. And once the market starts to price that in, growth stocks, speculative assets, long duration narratives, and anything priced for policy kindness begin taking punishment. This is why I do not begin by asking what story sounds exciting. I begin by asking what the central bank can still do without breaking something else. If the answer is not much, The market has a problem. Now we come to the third mechanism. I call it everything liquidation. This is the stage that confuses almost everybody. They say, if war is bad and inflation is bad and the market is scared, then safe havens should rise, gold should rise, silver should rise, defensive assets should rise. Yet what actually happens in a real phase, one shock is uglier. Everything gets sold. Why? Because phase one is not an opinion phase. It is a forced selling phase. Funds de-risk. Leveraged players get hit. Margin desks make calls. Investors sell what they can, not only what they want to. Good assets get dumped alongside bad assets because liquidity becomes more important than elegance. That is everything liquidation. It is one of the most emotionally destabilizing stages in all of investing because it makes nothing feel safe. The investor says if even gold is down and quality stocks are down and the broad market is down, then what exactly is the point of diversification, quality, or strategy? The point is not that they save you from all pain immediately. The point is that they determine what survives the forced selling and what recovers when the forced selling ends. That is a very different promise. In phase one, you do not learn what is loved. You learn what is liquid and what is leveraged. That distinction matters enormously because phase one punishes everyone who thought owning the right thing meant the path would be smooth. It never meant that. It meant the right thing would still deserve ownership after the panic machinery had finished chewing through the weakest hands. Now let me give you the fourth mechanism. I call it policy panic. Once markets fall hard enough, and once financial conditions tighten enough, and once the political and economic cost of the shock becomes visible enough, governments and central banks start looking for escape valves. That does not mean they will always succeed. It does mean they will not sit there calmly while the whole machine burns. Policy panic is the moment when officials stop pretending the system can absorb the pain elegantly and start reaching for whatever might stop the bleeding. It can take many forms: de-escalation attempts, temporary tariff relief, targeted support, bond purchases, liquidity injections, messaging pivots, regulatory leniency, a softer stance than seemed imaginable 2 weeks earlier. That is why I say phase one must be survived, because phase two is often defined not by a beautiful economy, but by the market realizing that the policy class is now frightened enough to intervene. The investor who goes broke in phase one does not get paid by phase two. The investor who panics out in phase one does not benefit when phase two changes the tone. The investor who maintained discipline, managed risk, and preserved capital is the one who gets the option to profit when policy panic arrives. That is the sequence, and sequence is everything. Now let us move to the fifth mechanism. I call it rotation harvest. Once the first shock passes through the system, the money does not simply return everywhere at once. It rotates, it leaves what was overloved, overowned, and overvalued. It seeks what got too cheap relative to a world where policy is now leaning toward repair. The dollar may weaken, rates may eventually soften, and selected beaten. Down sectors may have already priced in too much fear. That is why the biggest money is not usually made by guessing the first day of the panic. It is made by understanding where money will go once the panic has done its damage. Consumer discretionary after extreme pessimism, software if financial conditions loosen, consumer finance if rate pressure softens, gold if the policy answer involves more printing and a weaker dollar, international assets if the dollar-S premium begins to fray, selected energy, infrastructure, and pricing, power businesses if the shock persists longer than expected. The specifics change. The principle does not. Money rotates from the forced sellers to the prepared buyers, from the obvious winners of the old regime to the likely winners of the next regime, from the narrative that was fashionable to the asset that is now positioned to benefit from the response. That is rotation harvest, and it is why I care much more about flow than about headlines. The headlines are theater. The flow tells you when the market has begun shifting from liquidation to accumulation. Now we come to the sixth mechanism, and this is where most retail investors lose control of themselves. I call it phase confusion. This is one of the oldest investing errors in the book. People try to make phase 3 decisions during phase 1. They buy beaten down assets as if the policy rescue already happened. They size positions as if volatility already calmed down. They assume the bottom should be near simply because the sell-off feels dramatic. They treat pain as proof of opportunity instead of first asking what stage of the sequence they are actually in. That is phase confusion. And it is lethal because even if the asset eventually recovers, the path can still destroy the investor who entered with the wrong size, wrong leverage, wrong risk plan, or wrong expectations. This is why I always come back to rules and skills instead of news and excitement. If you cannot survive phase 1, phase 3 is irrelevant. That is not pessimism. That is professionalism. The right mentality in a real market shock is not how do I swing for the fences. It is how do I remain intact enough to exploit what the shock creates later. That requires 3 things. First, no reckless leverage. Leverage is wonderful in a calm uptrend until it becomes the thing that decides for you. If a 20 or 30% drawdown in a specific pocket of the market would cause you to panic, blow up, or get forced out, then your structure is wrong before the market is wrong. Second, core preservation. Do not destroy the heart of a long-term portfolio because phase 1 is ugly. Good broad exposure with time can survive. Reckless concentration in fragile names is something else. Know the difference. Third, watch flows, not television. Policy changes, yield changes, dollar changes, sector money flows, real signs that capital is rotating. Those matter, emotion does not. Now I want to force the identity shift because without it you will keep reacting like a spectator. Stop thinking of yourself as a crisis predictor. Think of yourself as a phase navigator. A crisis predictor wants to sound smart before the move. A phase navigator wants to survive the move and exploit the sequence after it. A predictor obsesses over whether this is exactly like 1973 or 2008. A navigator asks what stage we are in, what the policy constraints are, what the oil shock is transmitting, what is being liquidated, and where money is likely to rotate when the response begins. A predictor wants the perfect call. A navigator wants to still be standing when the real opportunity appears. That is the stronger identity. And it leads to a much more useful operating system. First, accept that a major oil spike is not a headline. It is a macro transmission event. Second, respect that phase 1 can be an everything liquidation where even correct long-term hedges get hit because forced selling dominates. Third, understand that the Fed and policymakers can be trapped before they panic. That is the stagflation problem. Fourth, remove leverage and size positions so you can survive uglier paths than you emotionally hope for. Fifth, keep the core, trim reckless exposure, and avoid giant all. In bets on what you think must bounce. Sixth, wait for money rotation signals. The best sectors later are not always the safest. Looking sectors in the first week of panic 7th, remember that phase 3 profits belong to the people who did not self-destruct in phase 1. That is the rule. Now, let me end where this really matters. You can look at this environment the way most people will. You can see oil screaming higher, markets falling, safe havens wobbling, and assume the whole thing is chaos. You can let the news fill your head with urgency. You can chase what already ran. You can sell what just fell. You can try to make phase 3 money with phase 1 emotions. That is how ordinary people take a survivable shock and turn it into a portfolio wound that lasts years. Or you can choose the harder, quieter path. You can admit that we are in the forced selling stage. You can accept that the market may get uglier before the policy panic begins. You can protect capital, remove leverage, keep the core, and study where the eventual rotations are likely to go. You can prepare yourself to act when the sequence improves rather than pretending it already has. That is the threshold. Because the real opportunity in a crisis does not usually belong to the first person who feels brave. It belongs to the person who understands the phases well enough not to confuse survival with hesitation or patience with passivity. Let's put us in the oil is not just another commodity. It is the trigger. That person knows the market is not just falling. It is repricing the system. That person knows phase 1 is for discipline, phase 2 is for observation, phase 3 is where the profits come. And if you can live by that sequence, this crisis stops being just another terrifying news cycle. It becomes a map, not to easy money to earn money, the kind of money made by people who knew that surviving the first part of the storm was not separate from making money later. It was the price of admission.